Imagine you hired an electrician to repair something at your house and they showed up with no tools. Or imagine they showed up and started using a screwdriver to hit a nail. You'd be pretty confused, right? There's a job that needs to be done and there's the right tool to use for that job. Just like an electrician, option traders have a suite of tools that they use too. But instead of hammers and screwdrivers, they use what we discussed in the last video, they use option structures. Now there are two primary structures that we are going to cover in this video, which will each be used to run a specific trading strategy with the predicting alpha terminal. Each of the strategies are evidence-backed, profitable strategies. And by using the right tool for the right job, we will be able to monetize these strategies and use them to build our trading businesses. The two tools that we are going to cover are called straddles and calendar spreads. Straddles are the option structure most commonly used to trade implied volatility versus realized volatility. If we think that implied volatility is high or expensive, we can sell a straddle. What we're going to do now is analyze what a straddle looks like and talk about it more in depth. Now, typically, the way a straddle is structured is by selling a call and a put at the same strike, typically at the money. So right now we're on the option chain for Apple, which we're going to use for example. We're looking at the December 16th expiry. And what we're going to do, stock's trading at $148. We're going to come to the 148 strike, right click it, sell, and go to straddle. What we're going to do now is actually analyze this trade and talk about it more. So this graph right here is what a straddle actually looks like. A quick overview of this graph is this purple line is our current payoff. So at different prices, which we see at the bottom, given the trade we have on right this second, here's what our P&L would be at different prices. Looking at this yellow line here, we can see today's price for the option, where we're at right now. And we can see we're basically at $0 because we just put the trade on. Now, this blue line is what our payoff looks like at the option's expiration. So if we move time forward, you can see that the purple line slowly converges with the blue line, becoming it. Now, a couple things to notice about this graph is right at inception, look at how our P&L, this little number right here, changes as the stock goes down or goes up. Well, we actually don't see very much change in the price of our straddle or our P&L. And this is because by selling the call and the put at the same strike, at the money, it gives us a delta neutral exposure, right? We're talking about option Greeks here, which is a concept covered in the silver level of the PA Academy. But what we're basically saying is we don't really care if the stock goes up or down. That's not really what we're trading. What we really care about is how big these moves are going to be. You see, as time moves forward, if we see only small moves, look what happens to our P&L. If we're staying around the 145 here, all of a sudden our P&L really starts to shoot up, becoming higher and higher as we approach the expiration. And this is because if we stayed around here, it would mean we're realizing a lot less volatility than what the market implied. But at the same time, let's say we see a big move down. Price jumps down to $138. All of a sudden, we're losing money because our break-evens at around 140 and 155 are the implied move range that the options are saying to us, right? This is that implied volatility range that the market is pricing the options at right now. So if we think that the move is going to be less than this range, which is what our strategies will help us figure out, we want to be selling a straddle like this. And if it stays inside this range, we're going to make money. Now on the flip side, let's say we see the stock slowly start to trend this way. We're not actually seeing these big moves the market thought, but the stock is going in one direction. Well, we could end up in a situation where over time, these small moves add up to getting us outside of our profit range. Well, to handle this, there's a concept called delta hedging. We can actually come in and let's say the stock moves down to here. We can actually reset our delta so that this point in the graph is now the flat point, meaning we no longer care again if the stock goes up or down. And that's what we're going to do if we want to actually stay delta neutral if the stock starts to trend outside of our range. And this is also a concept covered in the silver level of the education, which I highly recommend you check out as you start to run strategies that use straddles. So if we were to summarize what this straddle is telling us, the market is saying that the stock is going to move between this range here, between 140 and 155, between now and the expiration on December 16th. A good analogy for how to think about this range is that we are selling insurance. We are basically selling someone the right to make some money or to offset some losses if they hold the stock, if the stock actually moves outside of this range. Now for our trading purposes, we are going to use this structure when we find trades where the implied volatility is higher than what we think the realized volatility will be based on the data we have. and you will be using this in 2 of the 3 strategies we will talk about later in this quick start course. Now we are going to go over one more tool which we're going to be using, and it's for a very specific, highly profitable strategy that you'll learn in a little bit. So coming back to the option chain here for Apple, the structure we're going to look at next is called a calendar spread. Calendar spreads are a very cool structure because they let you put on a market neutral trade, just like the straddle, but we can do it for a debit, meaning we don't have that unlimited risk that we were seeing with the straddle. And this is what usually attracts traders to using calendar spreads. But if we look under the hood of this structure, we find out that there's actually something very unique about them that can be a little dangerous if you're not familiar with it, but also extremely powerful once we do. So let's go ahead and structure a calendar spread. We're going to do the at the money calls. We're going to go buy calendar. And looking down here, we can see that the way the calendar is set up is we are buying the December 23rd expiry and selling the December 16th. Both of them calls, but what's interesting is we have 2 different expirations here. Let's analyze this trade and look deeper into it. But here's what our calendar spread looks like. Kind of similar looking to the straddle if you think about it, except as we go further out, we actually flatline in our risk, and that's because we're buying it for a debit. Now, this is the main thing we need to be aware of when trading calendar spreads, is that we have these multiple expirations. Now, this concept can be a bit tricky, but the reason it's important is because it means we have exposure to how volatility changes over time. For example, let's say the market originally thought we would see a lot of stock movement before December 16th, and then things would calm down before December 23rd. Well, that means the December 16th options would be very expensive and imply a lot of movement, while the December 23rd would be implying less. Well, then imagine a couple days pass, and then the market says, wait a minute, things are actually going to be pretty calm before December 16th, and then that's when things are going to pick up. And December 23rd is the time frame we're going to see a lot of movement by. Well, the market would then adjust its pricing. The December 16th, which we sold, would become a lot cheaper, and the December 23rds, which we bought, would become a lot more expensive. And putting on a trade like this, we would make a ton of money, right? Let's say the implied volatility on this one dropped by 10%, right, on the December 16th, and let's say it increased by 10% on the December 23rds. Look at that, we would make a ton of money literally just from that change happening. Another example would be, imagine a stock has a huge piece of news come out. Well, these close dated options, the December 16th, might really shoot up in value as the market anticipates more movement from the stock to happen. While the December 23rds maybe won't change as much in price because the market expects things to calm down again by then. But let's say we disagree and we say, no, the news is already out, the market's already adjusted its pricing, why should the stock continue to move if everyone's aware of the news? Well, in that case, we could go and sell the December 16th and buy the December 23rds as a hedge. And once again, if things do calm down, we would make a lot of money putting on a trade like this. Now, we have a lot of education on calendar spreads in the Gold Education, where you will learn about how volatility changes over time and a very cool concept called forward volatility. We will also be using calendars to trade a very profitable quantitative strategy, which we're going to talk about later in the course. In fact, it's one of the strategies that we have built an entire dashboard dedicated to it, with every piece of data you need to run the calendar spread strategy as a part of your portfolio. This strategy is also really good for small accounts or more risk-averse traders, since it is a risk-defined trade and can also be traded for a very low cost basis, right? Think about this. We have 10 calendars on Apple right now, a pretty big stock, and our max risk is only $500, $600. So in summary, Straddles and Calendars are the 2 main tools that we will be using by the end of this course. Now we'll go over 3 strategies that use these tools that you can start executing today. These strategies are the option seller strategy, the earnings strategy, and the calendar spread strategy. So let's jump into a quick video about the dashboard we have built for each of these strategies, and then we can break them down one by one.